You should be. Cool. Okay. Welcome to Fairground Jam, which is our weekly jam where we talk about things that you can do on Fairground, the Vega testnet, and either talk about or educate or work something through something new every single week. And afterwards, we have an open Zoom room. I will drop the link in the chat for people watching this retrospectively. If you have any questions about things we talk about, please come chat with us in Discord. So today I have Vitold here, who is going to talk about and show you how you can provide liquidity and why we've made the decisions we've made in designing the protocol. And if you have any questions please write them in the chat and we'll get to them at the end. So with that, I'm going to hand over to you, Vitold.
All right, thank you for the intro, Kristen. And I think we can actually handle the questions as we go along. I'll leave it up to you. You've got more experience in this. But yeah, please do ask questions in the chat on Twitch. And if for any reason we don't get through your question, please, if you could repeat that on Discord, and I'll be checking that this evening, and I'll get back to you. Cool, so let me share my screen. So today is all about liquidity. I'll assume you've got some basic familiarity with our testnet. If not, do not hesitate to ask about questions. But I'll keep it very accessible. I just want to explain all the steps and so on. So let us actually go through some slides to begin with, because I've run a workshop at a conference a while back on our liquidity mechanism. And I think it will be worth to quickly go through some of those at least, just so we have some common ground as far as understanding liquidity goes, and how we designed the liquidity provision within the Vega protocol. So liquidity is a bit of a strange one, at least to me, because it gets tossed around so much, but and so it's not quite left phalange, but it is a bit of a mean old word. People generally agree it means something good and with finance, but it means different things in different contexts, which is fine. But it's not really something we can work with when we're trying to formalize this into a protocol. So we actually came across a nice definition of it in a paper by Black from 1971. That's the Black of the Black-Scholes fame. So he defines a liquid market as one where there are always bid and ask prices for investors who want to buy small amounts immediately. He also says that the difference between those prices should be small, so a small spread. And that if someone is willing to buy or sell a large amount of stock over a long time and there isn't really much new information coming to the market, they should be able to do it at the price that is on average not very different from the current price in the market. And then if someone doesn't want to do that over the long period of time but wants to do that immediately, he'll have to pay a premium, also known as the slippage, and that will grow with the size of the block. So if I want to buy a huge chunk of some futures position, let's say, I'll be consuming a lot of the order book, so I'll move the price quite a bit, and therefore I'll have to pay a premium for that compared to where the market is at right now. So yes, hopefully that gets us on the same page with what we mean by liquidity within Vega. So why do exchanges care about it at all? So it lowers the execution costs and then decreases the risk for traders. That's just because, you can always buy and sell immediately, so you can get out of any position that you may have if the market starts going against you. If you're implementing some more complex strategies through, let's say, trading bots that rely on instant availability of stock, that is also easier to achieve. It also improves the price discovery because any order coming to the market is more likely to result in a trade that moves the mark price, and the market progresses more smoothly, as opposed to what would happen if we only generated one trade an hour because there was so little liquidity. But perhaps most importantly, at least for a derivatives exchange, and Vega is a protocol foremost for the derivatives. It allows a safer operation. That is because when parties are trading on a margin and the market moves against them, will be trying to top up their margin from their general account. But if there are not enough funds there and the market keeps on moving, we'll eventually have to close out such a trader. And to be able to do that, we need to take the opposite position on a market. And for that to happen, there needs to be orders on the order book. So in some sense, the liquidity providers within Vega play a very important role, not only in making it a better experience for everyone trading, but also so that the protocol is safe and we can close out any parties that are close to bankruptcy. And yeah, there's this saying, liquidity begets liquidity. So basically, the more liquidity you've got in your market, the more parties are more likely to trade on your venue and not a different one. And that by doing that, they themselves bring more liquidity. So for that reasons, the exchanges have always been interested in kickstarting this process. And traditionally, they've done that through some bespoke legal agreements where a bunch of lawyers and financiers would get into a room, discuss the terms of the contract, and the market maker would provide liquidity, very narrowly defined. So like some, percentage of the order book volume could be over a period of time. And then again, those contracts would have to be enforced. There could be some legal action. So everything fairly complicated, definitely expensive, and definitely not what Vega is about, because we want markets to be as open as possible to everyone so that they can be easily created. But of course, creating a market is only half the battle, or some fraction of the battle. But market is only useful if there is liquidity. That's why we're trying to solve this problem within the protocol itself, and hence the liquidity provisioning feature that we'll be looking at. And I promise I'll jump into the console and show you guys how to do that on a live market on Fairground soon. Just a little bit more theory before we get there. So, when setting to design this, a few years ago, we had some design principles in mind that have then motivated our further research and mechanism design process. So basically, we wanted to provide incentives for liquidity providers to bootstrap early markets, because that is usually the biggest challenge when you have a market for. It could be just a market for a new derivative, but it could be a whole new financial product that's not been traded before. It's not very well known. It could have huge social utility, like let's say, I don't know, weather derivatives. But because it's so new and requires a bit more research before people get into it, these markets are usually very illiquid to begin with. And sometimes that seals the fate of those markets and they never take off successfully, and they end up being closed. So yeah, we wanted to make sure that it is profitable for liquidity providers to join any market, but especially early markets, so that the rewards they reap from those types of markets, if they become successful, are proportionally higher than rewards from entering a market that is already very liquid. And obviously, any additional liquidity is always welcome, but it's not as crucial from the point of view of the market, of such market compared to an early market. Yeah, and we want this to be open to anyone, so that, again, you don't have to go through a bunch of meetings contracts and whatnot, but it can be just done on a self-serve basis by using the protocol. And we also want this to be competitive. So we want the fees to be as low as possible for traders. So just because someone has a lot of capital to deploy as a liquidity provider, we don't want that to allow them to choose any fee they want, set them arbitrarily high. I mean, of course, they wouldn't if they are rational agents, because the more trading volume, the more fees they earn, because that is the return from them. They get a portion of the fees in the market. But still, we want this to be able to, we want the liquidity to be priced dynamically, so that if the liquidity drops, it's easier to suggest maybe slightly higher fees, and that draws new entrants into the market. But then if the liquidity providers set fees that are too high, then it's easy for someone to undercut them and change the fees. So let's maybe cover liquidity demand as well. So if we want to design this mechanism that governs the liquidity in the market, we need to somehow assess the demand for such liquidity. And to begin with, so when the market opens, it's part of the market proposal. So we set the target stake for the market. But as the market evolves, so as soon as the opening auction uncrosses, there's some open interest. So that's the way we currently estimate the liquidity demand. It may change over time, but we basically take open interest. So open interest is just the sum of all long positions in the market, or all short positions. It's the same, but basically means how big the market is in terms of open contracts. And we just take a sliding time window, and we take the maximum over that window. And that allows us to inform the protocol, as to how much liquidity is required. So how much liquidity we want the liquidity providers to supply. And if the liquidity is supplied, we've got protection measures in place. So if that happens to be the case, so the supplied liquidity is too low relative to the target liquidity, then the market goes into the liquidity monitoring auction. So it will be trading in auction mode. Just a quick digression. So when the market is in continuous trading mode, as soon as the buy and sell orders match, a trade gets generated, those orders get taken off the book, and everything carries on. When a market is in auction, that no longer happens. So it's still accepting orders. They can be canceled, amended, more orders can be added. And the order book will likely be in a crossed state. So there will be some buy orders that want to buy for a price higher than some of the sell orders. And upon auction end, trades get generated so as to maximize the volume. Those orders get taken off the book, and market returns to the continuous trading mode. Okay, so let's take a break from the theory, and let's go to testnet. So we can see that that's the default view. It's the same for everyone who accesses testnet for the first time and has not customized it in any way. And so these are the available markets. So let's maybe have a look at the ETH BTC quarterly futures. So let us create a new workspace. I hope everyone can see the screen okay. If anything's too little, let us know on Twitch, and Christina will give me a nudge to change the settings. So this is the market details view, right? So it's got some basic market data, current fees, and liquidity. So target stake is this liquidity demand measure that we've just discussed in the theoretical slides. And then supplied stake is how much stake each of the all of the liquidity providers are currently providing to the market. We'll talk a little bit more about what a stake is, how it relates to other concepts in a moment. And there's also this market value proxy that is used for distributing fees among the liquidity providers. But again, we'll touch on that later on. And if we click here, we can see all the liquidity provisions in a market. So we can see that there's some parties, and these are just our liquidity bots at the moment. They are all bidding the same fee of 0.1%, and they are staking around 100 BTC each. But because we've seen that the target stake is so low, even though I don't have tons of collateral, let's see how much I actually do have. I have 41, so let's deposit 20 BTC. I need to interact with the MetaMask wallet for that to happen. We will now need to wait for 3 blocks for the deposit to be registered on Vega. But while that is happening, let us maybe quickly have a look at the fees as well. So this view sets the current fees on Vega. So there's 3 types of fees. One is infrastructure fee. That fee will get, so each of those fees gets, infrastructure fees and liquidity provision fees, they get accrued in buckets held within the markets. And once every few minutes, depending on the network parameter driving these, they are distributed. So infrastructure fees go to the node operators and those delegating their Vega tokens, whereas liquidity provision fees get distributed among the liquidity providers. And the maker fee is a fee that goes to the maker of a trade. So if I place a limit order on the book that doesn't trade immediately, but then gets hit by another order. So someone else submits an overlapping order from the opposite side, and a trade is generated. I make this portion of the fee, and these percentages are calculated. I mean, they are applied to the notional value of the trade. And let's see if okay, so I now have 20 BTC available. As we can see, the target stake is really, really low. So let us go to the ticket for creating an order. And yeah, we want a liquidity provision order. So this commitment is how much I am willing to stake as a liquidity provider. And the more I commit, so this commitment amount gets translated into the amount of liquidity that I will need to provide. And I can either provide that liquidity manually by just submitting limit orders. And by manually, I don't necessarily mean interacting with the UI. I mean, you could do that, but it would be fairly cumbersome. But you could have a bot running in the background using the API to interact with Vega, placing orders for you. So you can employ any market making strategy you may wish to do, as long as you provide enough liquidity for those limits orders. That's the only orders that will be on the book. But as a fail-safe mechanism, we also require liquidity providers to provide those what we call order shapes. So these are sets of pegged orders. You need to provide at least one, but you can have a few if you wish to. And what happens with those is that if my limit orders are not enough to cover my liquidity commitment, these will get deployed automatically. They are pegged orders, so they are, in this case, they are pegged to a mid price. So these are my buy orders where I'm willing to buy at 0.1 of a basis point below mid and 0.2. and 1 and 2 above for the sell ones. So they will get repriced every time the mid price changes here in the market. And their size will also be continually reevaluated to make sure that they are providing enough liquidity. So if I supply more limit orders, the size of those orders will drop. if some of my orders get filled, they will be redeployed, those orders, to make up for the liquidity commitment that is required. So let us start with something quite conservative. So we'll be far away from the mid price. And let's not worry about those proportions just now. And we also need to submit a fee bid. And we saw that all the prices were 0.1 of a percentage point. But let's say we think that is too high and we are happy with lower fees, so a bit less revenue from each trade, but we think it's going to boost the trading. So let's set them to half that amount. And now we place a liquidity provision. It is getting submitted. So let's make this smaller. Just now, I don't think we need the markets view anymore. So you can see that now from the 20 BTC that we've deployed, 1 was placed in the bond account because that is how much we wanted to stake with this liquidity provision. And about 9 is used up for the margin required to secure the liquidity demand coming from that commitment. So that is quite a lot. The reason why this is a lot is because those orders are huge. And the reason they are huge is because they are far away from the mid price. And we'll jump back to the slides in a moment to talk about this in more detail. But basically, we are weighting all the orders by the probability of trading, and the lower the probability of trading, the higher the size of those orders required to fulfill the commitment. And that goes back to our design principles. So we want liquidity providers to be as active as possible. So we want them to provide competitive pricing that is making spreads small. Because if we weren't differentiating between that, a fairly cheeky and profitable strategy would be to just place your orders as far away as possible. The likelihood of them ever trading is very low. Like, as you can see, my position here is still 0, so nothing traded. And a big part of market making is managing your inventories. Because as long as the price fluctuates around the current level and there's roughly the same amount of buys and sells in a given period, your position will be around 0. It will go up and down, and that's fine. You're still making money from all those trades. 1, through the maker fee, 2, through the liquidity fee. But if then the market jumps to a different region and that moves against your position, so if, let's say you had a big long position, but the price dropped in a market, you now have a bit of a problem, because if you, on one hand, you don't want your position to keep growing, because that is that means then you have to redeploy more orders, and that position is at a loss. So you basically usually want to either wait till market gets back into the older region so you can have a smaller loss or maybe a profit on that position. But yeah, in general, you don't want to allow those positions to grow too quickly. You want to manage your inventory so that it is around 0 most of the time. So let's now see what happens if we place a limit order that is a bit more competitive. So you can see these are my buy orders. So they are around 0.06. So if I have something closer to mid, like 0.63, I've placed that now. Okay, but that got filled, so that's unfortunate. So for a moment, let's maybe try and be a little bit. Oh yeah, okay, that's silly me. That was actually crossed, so I would have traded immediately. So 0.61. But that's not much better than something like this. And yeah, you can see that now all of my automatically deployed orders for I only have the ones for the sell side because the limit ones are enough to cover my liquidity commitment. If I cancel them, the automatic ones will get pre-deployed. So this is a fail-safe for us. So market makers or the liquidity providers can have as elaborate a strategy as they want, but if at any point in time they are under supplying liquidity, we are deploying those orders for them, and you cannot cancel them. That won't do anything. We'd be using the margin and general account balances for the margin required for those orders. But if they are not enough, we'll dip into the bond account to use that for the margin, and the liquidity provider gets a small penalty applied as well. So a bit of that amount will go into the insurance pool for the market, and that is to discourage liquidity providers from relying on this bond as the source of funding. This is just a additional collateral because we want those positions to be very safe. Because as we've said, this is the basis of our risk management to some extent. Okay. So let us jump back to the slides for a moment. Oh, sorry. Let us actually verify that the fee that we've proposed. Let's reload. Yeah, so as you can see now, the liquidity provision fee is 0.5%, 0.05%, because our stake of 1 BTC was enough to provide the fee for the market, to set the fee for the market. And I'll talk about the mechanism it uses for that in a moment. So slides. Yeah, so basically when we're setting fees for the market, we have this measure of the liquidity demand that we've talked about before, and we need that demand to be met. So we're taking all those liquidity commitments, just like the one that we just submitted from all the liquidity providers in the market, and we are sorting them by the fee level from lowest to highest, and then we're just picking them off going up in fee. And as soon as our accumulated stake, so the sum of those stakes from all those different liquidity provisions is at least the required stake, then that is the fee for the market. Other liquidity providers, so those guys are still in the market, even though I'm the one setting the fee now, because, from the point of view of traders and the protocol, there's never too much of that supplied liquidity. But they have to agree to the fact that the fee is now this, so their bids are irrelevant in this case. Though they may be relevant if the demand for liquidity goes over 1 BTC, and then the price would be averaged, right? So if the demand was 2 BTC, I'm only supplying 1, it would end up being 0.075% and so on. So that's that. And now a bit more about how we measure liquidity. So as I've told you, the commitment amount in the liquidity provision order translates into the liquidity commitment from each trader. And we are checking how they fulfill this commitment so first, so that this is our measure of liquidity, and we take the minimum of the buy and sell side, just because we don't want one-sided liquidity. So if it wasn't the minimum, but let's say someone could jump on one side of the market if it's going in one direction, hoping they won't really interact much with other orders, and then the opposite if it's going in a different direction. But this assures that these are fairly balanced because it's only the minimum one that matters. So there's not much incentive for them to make them hugely different. And looking at just buy side, let's say, we'll be looking at different price levels going from the mid, the volume at that price level, and then the probability of trading at that price level. The way we estimate probability of trading is with our risk model, because if you remember, there are risk models underpinning each market on Vega. They are used for estimating the margin amounts for each position. So the more risky the market, the higher the margin amount, so the lower the leverage. They are also used for price monitoring. So we have this whole concept of price monitoring, and I'll run another jam on that in a few weeks' time. But they are stochastic differential equations, basically, those models. And what we get out of them for free is the distribution of prices at any point in time. And it will look something like this. Basically, the further away you go from the mid, the more that probability will be decaying. So if and going back to those order shapes, right? So here, this guy has specified 5 orders for each side and used equal fractions for them. But equal fractions, it doesn't mean they will have equal sizes. It just means the relative weight will be the same after accounting for the difference in probability of trading. But we see that the lower the probability of trading, the higher the order size, right? So with that knowledge, let us jump back. And because there can only be one liquidity provision per party, the way we amend them or cancel them is just by resubmitting the liquidity provision. So we'll go back to the ticket for the market, choose liquidity provision again. I don't have to, I can modify any of the fields, but if I don't want to change my commitment and my fee, I will just repeat what I've used before. And now let us, so as you can see, so for this buy side, I have much more volume on the one that is further away. Right? Sorry, they keep getting reshuffled. But if I wanted to change that the relative weightings, I would just manipulate this proportion here. And all this means it's relative importance. So if this has a 1, this has a 2, basically this one gets a weight of 1/3, this gets a weight of 2/3. But I could do something like maybe that. That resubmits the liquidity provision. So in this case, it acts as an amendment. And as you can see, the relative sizes have now changed somewhat. So it's this one and that one, yeah. Okay, so we've been quite conservative. The only open position we have is from that limit order that we submitted, but none of our liquidity provision orders that you can see here have been hit. Yeah, in fact, this one is so far away that it's not very likely to ever get hit. I mean, maybe not ever, but not in the near future. So let us now be a bit more adventurous. And we can just use one, actually. We don't need two of them. So I'm amending again. And that takes a while to appear. Yeah, and as you can see now, I only have two, one for the sell side, one for the buy side. And the sizes are much more manageable because we went much closer to the mid now. So now they are the prices, and you can see prices change all the time as every time the mid price changes. But we are now much closer to the action, so we're not far away from the staple here. Can actually probably go even closer. Yeah, so 269. So we were right at the best offer and best bid. And as you can see, my position is changing quite a bit. So now I'm net short and getting shorter. If the market moves in the other direction, I'll be getting less short and then maybe eventually go long. Okay. And let's say I would like to leave this. I no longer want to be a liquidity provider. That isn't always possible, just because we want markets to function properly. So you can always increase your stake, but you can only decrease it if doing so wouldn't put this required stake below the target, because that would trigger the liquidity auction immediately. The auction might still happen, but only because the target stake grows, not because the supplied stake shrinks so much as to go below this level. But since the market is so oversupplied with liquidity compared to its target stake, we can do that at any time. And the way to do this is to just enter the commitment amount of 0, resubmit. You can see that those orders now got canceled, and that's actually the only way to cancel those automatically deployed orders. And we've made quite a lot in fees because we've only deployed 20, if I remember correctly. But there's this slight problem that we have this huge negative position. And well, we can either leave that and close it later on. But if we wanted to get out of the market completely, we'd have to close it now. So let's go long. Yeah, but actually it wasn't so bad. So we made a small loss on this, but we almost doubled the initial investment now. Obviously, this is testnet with bots, so it's not a advertisement for the returns we will be able to get in this short amount of time. But the potential here is quite big as long as there's enough trading activity. And actually, most of those fees were earned through the maker fees because okay, so let us resubmit. So let us change our mind and say we want to be back in this market and with a higher commitment, maybe even 10, why not? And if we go back to the liquidity provisions page, there's this equity like share value here, and that is the proportion of liquidity fees each of those agents will get, and that's us, and we're at quite a low proportion because our commitment is lower than theirs. But I doubt we've earned any of those fees because if we go to docs and look up the network parameter that is driving the frequency of the distribution of those fees. So those fees get charged on every trade. It's the price taker that pays them, but they just get accrued in the liquidity provision bucket in the market. And they, oh, what's wrong with docs? I really hope I'm online and I have not been talking to myself for the last hour, but yeah, seems I am. Oh, by the way, there's this whole providing liquidity section in the docs if you'd like to explore this more on your own. But if we search for we can go here, and this not the crispest view, but it does the job. It displays the key value pairs for each of the network parameters on the network. And if we search for something like distribution time step, so market.liquidity.providers.fee.distribution time step. So the fees are distributed every 60 minutes the way it's set up now. So you have to be in the market for not necessarily 60 minutes, could be less because it depends on how long has passed since the last distribution event. But basically all the fees earned on orders since the last distribution will remain in the account, and then they will get divided among the liquidity providers according to those equity like shares. So they sum to 100%. And let's jump back to the slides for a moment. And this is how they are calculated. So your equity share, so this is just a normalization, right? So they all sum to 1, but more importantly, equity of each liquidity provider, it grows in the supplied stake. So the more stake I provide, the more fees I get, which is sensible given extra requirements. So, the more stake you provide, the more orders you have to maintain, the more it costs you. But because we didn't want this to be the only factor, it's also the ratio of the market value from when you entered to the distribution time that matters. So even if you had a small stake, but you joined the market very early, either very early when it was its market value proxy was low, or just at a point where its value dropped significantly, we would reward you proportionally more for being an early supporter. So you can think of it as a sort of investment, like VC funds sometimes, like the lower the value of something that you invest in, the higher your returns if that thing is successful. And the market value proxy is the maximum of those two. So it's either the traded value in period M times a scaling factor, or the sum of all stakes committed by liquidity providers. And the reason for this is that obviously there isn't any traded value at the beginning of the market. So we estimate it this way. And I think that is it, to be fair. So I'll maybe stop sharing just now. Let me just look for my notes if I talked about everything I wanted to. Yeah, seems like it.
That was pretty comprehensive.
Yeah, so that's it. And if you have questions, please do let me know.
Yeah, we got thumbs up and highs, but no direct questions, unless there's something coming at the end here. I think that was awesome, Mitchell.
All right, so we could do the open Zoom, right? If anyone wants to ask a live question.
Yeah.
And also feel free to just come to our Discord, and I'll be keeping an eye on it. I do anyway, but maybe more so for the next 2 days. And I'll try to answer all your questions.
Maybe people need more than 2 days to practice. But yeah, I will share the link to the Zoom now, and let's end this stream.
All right, thank you.
Bye bye.